Okay, so what do? Given everything we've talked about? I think one thing is acknowledge that volatility is here with us, and I think will continue to be. 2022, the bond market was down 13%. Broadly, the U.S. stock market was down 19%. We saw an incredible rebound, again, just in the last, largely in the last 2 months of the year. I would expect it to continue to move around as people speculate on whether or not we're going to go into a recession, what's going to happen in the Middle East, what's going to happen in the election, and so forth. So the way you defend against that is you want to keep a healthy amount of what we'll call reserves. So think about that as cash equivalents like money market. Think about that as ultra short-term investment grade bonds, whether municipal tax-free or corporate and agency bonds. You want to know that distributions that may be coming out of my portfolio have already been set aside and earmarked for that purpose. The other thing is don't give up on diversification. I mean, yes, it's been an incredible period for tech stocks and for U.S. stocks, but as I said, diversification is the only free lunch. And so I think that matters more than ever. And again, on reserves, it used to be if you set aside reserve, you get no return. But now again, Fed funds is 5.5%. So you can get 5 to 6% just to be prudent. You can get paid to be prudent. I mean, that's the first time we've had that in 15 years. We talked about interest rates finally normalizing. Again, look back through 150 years of data, you're usually around 3 to 6%. But I would expect a lot of volatility in where that yield is, right? So we were just about 5% in yields in October, and then have fallen below 4%. We could very easily move back directionally towards 5 or even beyond that. So I would be prepared for that, meaning bonds, from a price standpoint, carry with them a lot more risk than perhaps as was typical. Certainly, as we talked about, there's certain more risky sectors of the bond market that are yielding, high single-digit, even double-digit yields. All I would say there is there are some very talented, seasoned managers with a track record of success moving portfolios in and out and across those various sectors. I would not statically own any of those. Opportunities can open and close, and I'll say the fundamentals of that underlying bond issue can change dramatically in a relatively short period of time. So be careful in those sectors. The other thing is, I think there's sort of this belief that we've seen inflation and now it's magically gone or soon to be gone. And that's not consistent with history. Inflation usually unfolds in waves, and that's largely due to psychology, right? So we've all just experienced inflation. The next time as prices start to rise, people are going to go out and try to buy things in advance, worried that it's going to rise yet further. I mean, if you were the purchasing manager for a manufacturing company and you weren't either able to buy the inputs that you needed to manufacture your good, or they started to escalate in price, you don't want to turn to your CEO and say, shoot, I missed it again. So I think what you're going to see and what you saw in the 70s was inflation come back. And in part, they did that. Arthur Burns was the Fed chair, the Jay Powell of that time, trying to carefully manage that Fed funds rate and monetary policy to sort of guide that perfect landing. Really hard to do. And what you have to do is painful. So what worked ultimately is Paul Volcker comes in as Fed chair, takes Fed funds rates up to call it 20%, pushes the economy into a brutal recession, unemployment spikes, and it changes the mindset of the employee. Right now they have you can think about leverage over the employer. There are still jobs, not as many, that they can leave for and make a material premium above what they're making today. You have to shift that mindset to, I'm thankful to have a job. And then the associated increases with that also change. So don't be surprised if inflation kind of either hangs around higher than the Fed's 2% target level or even comes back in yet another wave. And so we think owning inflation-sensitive assets, whether those are energy, material, and mining companies or treasury inflation-protected securities that have a ratchet that moves with CPI, I think you just got to be prepared for another year like 2022 when stocks and bonds both may be incredibly volatile or even down, and yet other things like inflation-sensitive assets do work. We've talked about just how strong the U.S. markets are, and I think myself and all of us, right, as Americans, we're very proud of the fact that we have some incredible dynamics at work for us. I mean, we still remain an incredibly entrepreneurial country. Our laws, our markets are unrivaled when it's compared to others. So, but we do have a history of being overly excited about those things and pricing things at incredible premiums. So I would be looking for a margin of safety. And again, we've talked a little bit about international, and who knows how that'll play out. Again, I think probabilistically it's more likely international will outperform U.S. But no one would question international trading at closer to 12 times earnings versus the U.S. market trading closer to 20 offers a greater margin of safety. And even in 2022, when Russia invaded Ukraine, who would have thought that the international markets would have outperformed the U.S. markets? Why? Things in the U.S. were a lot better, but no one anticipated that risk. The U.S. was priced for perfection. International markets were unloved and cheaper. So I think pay attention to price and value. The other thing is take a look at your portfolio. Even if you have target allocations, commonly a portfolio might be 60% in stocks and 40% in bonds. You're overweight stocks probably because of what happened last year. Take the opportunity to trim and sell into strength and then bolster that 40% in bonds, giving you more ballast. Another thing that's not casual, again, that's really helped U.S. performance, both stocks and bonds, is the strength of the dollar. But as you will recall, the dollar has been, some would say, weaponized in sort of how we addressed and how we tried to penalize Russia in the aftermath of its invasion of Ukraine. Well, if you're a central bank around the world, all of a sudden you're looking at U.S. debt a little differently. And when you look at buying activity with central banks, they're not buying nearly what they were. And yet issuance, we know, again, we're running huge deficits, and the CBO and others project that only to continue. And supply demand, we've got an incredible supply of bonds coming on the market, and some of the biggest buyers that we've had in recent years all of a sudden are starting to fade and lose a bit of interest. So who's going to step in for that? So watch bond auctions. I know that sounds really exciting, but it is. And I'd say so far they're going okay, but they're not going great. And so that's something of concern to us is if you have a challenged, troubled bond auction, I think that would really spook bond investors. And then lastly, I would say, again, it's just going back to the beginning, the market feels complacent, and we're coming off of an incredibly euphoric time for stocks. That'll give way to concern and doubt. That's what a real bear market looks like. People just give up on it, and it's you'll start hearing things like, "Just stop the bleeding. I can't take any more," and you'll actually get to the point where people will almost give it away. And so that's on the horizon. That will come. It's just a question of when. And so I think there again, we in our portfolios and a number of people have passive exposure. So exposure to indexes. Just recognize again, those are expensive largely and they're concentrated. And so indexing works great. It's a momentum strategy, and we've had tremendous momentum in tech and in the U.S. That works great until you have a change in leadership within the market. And we've seen this time and again. Financials during the global financial crisis, the lead up in those stocks was incredible. Speculative tech around .com during 2000 was incredible. Japanese stocks in the 1980s, again, from a global GDP standpoint, a global market cap standpoint, made it up a huge part of the global marketplace. oil stocks in the 70s, the Nifty 50 we talked about in the 60s. I mean, just over and over again, investors get overly excited about these. It's not that they're wrong. NVIDIA, Tesla, these companies could all go on to generate tremendous profits. And in fact, if you go back to the dot-com era, Cisco Systems at one point was the largest single company in the world. Look at what happened. They've executed. They've on what they thought they could do. Profits are up dramatically. Revenue's up dramatically. Yet the stock still trades below where it did in March of 2000. So again, price is what you pay, value is what you get. And I think you got to be very careful with that. So best of luck to you, and look forward to talking to you next quarter.